and welcome to this week's Do More With Your Money podcast. It's episode 203, and I'm Lexi Walton, Business Development Manager. And today I'm joined by John Mason, Pension Transfer Specialist, Charlotte Armstrong, Client Service and Supervisor, and Jeff Casson, Chief Investment Officer. We're going to be doing a Q&A special from the public. And my first question is to you, John. How do I know if I'm in the right portfolio in terms of risk level?
Thanks, Lexi. So when it comes to risk, I always think it's a very personal thing. You know, what's the correct level of risk for one person won't always be the same for everyone else. And here at True Potential, we've got a kind of robust way of assessing risk. We use a multiple choice risk questionnaire, essentially 13 questions. And at the end, it spits out a result across our risk level. So at the bottom end, you've got defensive. At the top end, you've got aggressive, and then 3 risk categories in between. We carry out that risk assessment at least once a year. So always at the outset of an investment, we want to understand the correct level of risk, but also when it comes to the annual review, we like to reassess the answers that every individual gives, and just to make sure that the portfolio is still at the correct level of risk. We do it annually. That's not to say we always have to chop and change our risk levels once a year. I think whenever we're setting the correct risk level and the correct portfolio, we want it to be a long-term thing. So when it comes to that annual assessment, often if there's been quite a volatile year, it's natural for responses to be a little bit more risk averse. That's not to say we have to make a change. It just provides a good way of assessing where you're at in terms of your risk level. And if you ever want to reassess it on an ad hoc basis, you can always have a chat with your financial advisor, and they can go through the questionnaire and just compare that to the portfolio that you're invested in.
Great. Thanks, John. The second question is for you, Charlotte. What's the difference between your old annual suitability review process and the new yearly investment review that it's just launched?
Yeah, so it's just launched at the very, very start of this year. And what it means is that's slightly different for our clients. So whereas the old one that clients would complete, there is about 10 to 12 questions on there, depending on what your answers are. You'd have to complete a review for every single policy. But the new one that we've just launched, you only have to complete one review. And that includes for all policies as well. So a lot of our clients could have quite a few junior ISAs set up for their children. They've also got pensions, ISAs for themselves. Some clients could even end up with 5, 10 different policies. So it's very time consuming if clients were having to go through kind of every single one to complete those. So clients will only have to complete the one review now. It's much more engaging as well for our clients, and it offers a very personalised insight to how their investments have performed. Once the clients have completed it, it'll give them a very detailed action plan. So if they're missing out on any opportunities, so things like direct debits, rewards, things like updating your beneficiaries and reviewing them, it's going to give clients insights into all of those. If there have been any significant changes to things like assets or liabilities, employment status, what it's then going to do is put that on the action plan as well. And if there are significant changes, your financial advisor is going to discuss those with you.
Fab. Thanks, Charlotte. Anybody want to add anything into that?
And I think, is it right, Charlotte, that we can now link that to our bank accounts as well, so we're able to pull in data as well to make it much more rounded in terms of the process.
Yeah, that's right. You can link your bank accounts with it. So when you are completing your expenditure and things like that, it's going to give you a more kind of overall of your total wealth. Kind of, can you afford to put more in your direct debits and things like that? The goal kind of it is to help you reach your financial goals quicker. That's what it's going to design the plan for. And
probably helps with making it faster as well.
Yeah,
if we can link it through, rather than, I know for myself, I'm away looking for pages of reams of paper to fill in when you're doing it. At least if you can link it to the bank account, it's much easier.
Yeah, it's so much easier. It'll give an overview of what you're spending, kind of what's coming in, and it'll just help you fill in that section much more quicker. And it'll be more accurate as well.
Fab. Thank you. One for you, Jeff. With 2024 being the year for a lot of upcoming elections all around the world, how do you think this is going to impact markets?
It's a very big question, isn't it?
It is. You got a crystal ball ready?
There's a lot in that one. I was just looking at some stats earlier, thinking about this question. There are 4 billion people in the world's population which will be taking part in elections this year across over 36 different countries. So there is a lot of electoral calendar events to think about this year. From a markets perspective, do politics typically move markets a lot? Not really, unless there's significant change. And I think when we look back over the last 10, 15, 20 years, we think about those sort of seminal election changes, and we probably all think about Trump coming to power in the US and how that was portrayed. And there's a lot of travelling and arriving, a lot of volatility as we're hearing from candidates discuss what they may or may not do in terms of policies. So it's something that we have to be aware of. Can you manage a portfolio around an electoral outcome? It's very, very difficult, and not something that we would be recommending anybody tries to do. For the challenge that it presents, it's a 50-50. And I think, again, not wanting to weigh too much on the US, but the US election this year will be pivotal.
Yeah.
And we've already had that first round of the nominations in terms of that US process, how it works. And Mr. Trump is the leading Republican candidate. So Iowa just earlier this week endorsed him as the Republican candidate. We get New Hampshire next week. So that's really setting that in motion. If we look back to when Trump first came to power, thought it'd be very negative for markets. Actually, the market rallied very significantly on the day of the election results. So something there that we just have to be aware of. We'll never try and predict it.
Could be an interesting, yeah.
And we'll have an election closer to home probably as well.
Yeah.
As Rishi Sunak has suggested, something will come in the second half of this year as well.
Fab. Thanks, Jeff. Anybody else want to add anything into that?
I think when it comes to elections, it always provokes questions from clients. You mentioned a crystal ball. It's always difficult to say what will happen. It could change pension policy depending on the way the result goes. As Jeff says, the markets will do what the markets do, and all we can do is try and look through all of those short-term events and create a portfolio that can be managed for the long term rather than short-term goings on.
Yeah, great.
And I think that's the sort of the critical point around it. That's why the policies are the most important thing. Those policies are the things that influence market reaction, but it's understanding the policies, the implications of those, that is really crucial.
Yeah. Great. Another question. John, at what age can I begin taking my state pension?
Very long time for you, Lexi. It'll be quite a while
Thanks,
yet. At the moment, it's 66. So if you're turning 66 tomorrow, the chances are you're going to be able to claim your state pension. It's gradually rising up to 67 by the time we get to 2028. So those people in their early to mid 60s got to wait that extra year before they get to that state pension point at 67. Looking further ahead, it will be going up to 68. The plan at the moment is for that to be done by 2046. So at the moment, again, those in their mid 40s, they're probably going to start getting tied into that, waiting the extra year until 68. It'll be around 45 years old you'd have to be at the moment to start being affected by that. Everyone younger than that, it's 68 at the moment. Who knows if there's going to be further increases as we get towards that point. State pension obviously recently had its amount increased.
Yes.
The triple lock was maintained, a nice increase for everyone who's currently receiving their state pension, but also even if your state pension age is a few years away, those increases are essentially locked in for you. You've still got that inflationary uplift, so you can still look forward to benefiting from the 10% we had increase last year and the subsequent increase we had from the recent statement as well.
Yeah.
I think it's also worth thinking about in that context the fact that the age at which people can take the retirement package does keep increasing. So if we think about what that means for each of us as individuals and anybody listening, it's probably the need to do more yourself.
More planning.
Because that length of time is getting pushed out, and probably in a number of years it'll be over 70 before you can draw on a state pension. That being the case, people need to take control and look to think about how they can use the products that we offer to allow them to meet those goals as well. So I think if you are in those periods of time, it's worth, as John's alluding to there, speaking to your financial advisor to understand what else you can do to mitigate the retirement plans, because probably most people want to retire before they get to 68 or 70 in an ideal world.
Yeah.
So taking back some control of that's quite crucial.
Absolutely, I think, and through the personal pension as an example, it's the place where many people save regularly into. Of course, you're allowed to access those from your mid-50s at the moment. it's going to creep up in line with the state pension age, as you say, 57, 58. But if you do want to retire a little bit earlier than your state pension age, it's great in terms of flexibility. So from an advice point of view, we're always looking at, well, if you do want to retire a little bit early, whether it's 60 or 65, you can take a little bit more from your pension perhaps in those early years, but you know that you've got that guaranteed state pension coming in, and the flexibility of the product allows you to reduce your withdrawals at that stage, make sure you're continuing to be tax efficient and not taking too much income. You've got that flexibility, which is really useful as well.
Brilliant. Which I guess links in with the annual suitability reviews in terms of checking in with your financial advisor each year closer to retirement is even more important in that respect. But I guess just making sure that you've got that contact and that plan for retirement.
Absolutely.
Next question is for you, Charlotte. How can I recover my workplace pensions from previous jobs that I've lost track of?
Yeah, so we actually have a service, the True Potential, that can do that for you. So if you go onto the True Potential website, there's an option there, click on pensions, and then you'll find an option just below, Find My Pension Service. What this is, it'll ask you a series of questions from who are your previous employers, what were the years, have you held any different names? If you do have any policy information, that's absolutely fantastic. But all we need to know is the employers that you worked for. What that'll then do is send a message over to one of our teams and we'll locate those policies for you. So it's a really, really good way to consolidate all of your pensions if you are wanting to transfer them over. You'll have complete view of them kind of all in one place. And again, it's going to help you reach your financial goals a little bit quicker if you've got more oversight of them. A lot of the clients who submitted information to us to help try and find them didn't even know that they had these policies. So,
nice surprise.
And a very nice surprise. So an extra little bit to top up to these has been really helpful. Some clients who have submitted them have given us about 20 different bits of information. So it's kept the team quite busy when they are looking for them. But a lot of our clients have been very pleasantly surprised on what they have found.
The team have been really successful with it, haven't they? From start to where they are now, I guess.
Mm-hmm. Yeah, well, pretty much they do absolutely everything. Yeah. They kind of reach out to these employers, get all these bits of information. So the client doesn't have to do a thing. They will keep them updated kind of all the way through, and if they do decide to transfer them over, they'll even kind of hold the hand, go on the client site with them and help them action it that way. But it's probably worth pointing out as well, there's no fees for it. It's all completely included. So if it's something that clients are wanting to do, I definitely suggest that they either give us a call or fill in the online form.
Great.
I think it's a very personal service as well.
Yeah.
It's not like you're going on and you're just putting your detail in. It's off to the government site that helps you locate it. It's actually a team of people that are sourcing it and finding those lost pensions.
Yeah, it is. Yeah, we've got quite a few of them on the team there who work really, really hard to find them, and then they'll just kind of update you step by step. And then if you do decide to submit it, the client site will give you updates as well on how that transfer is progressing.
Yeah, they're actually looking at mine at the moment, so I know they're really good. They're sending me lots of messages and coming down. They even came down to get me to sign the letter of authority and everything like that. So they've been really, really helpful, really useful so far. One for you, Jeff. Inflation is said to be on a downward trajectory this year. When will we see and feel a difference in the economy?
I think we would all, and we would as an investment team, contend that, inflation has peaked. It certainly has declined a lot, and we would use the term disinflation as to where we are at the moment. I think the challenge that we've got there in terms of thinking about inflation in a downward trajectory is that inflation will still be there. So prices will be still rising. I think that's the important thing. Inflation is part of a normal functioning economy. It's the level that's the challenge. If it's maybe that 2 to 4% range where people have operated in for most of time, that is acceptable. People are willing to accept that. I think when we're talking about inflation as to where it got last year in terms of 10, 11, 12% in the UK, 9% at a peak in the US, that's a very different level of price change that we're having to deal with. And remember, that's an average. There are areas within that where prices have increased quite dramatically. If you think about insurance, there's some of the insurance costs have increased 30, 40% year on year. So it's that combination of things that is problematic at that higher price level. Inflation is part of just a natural economy. And I think that's probably some of the challenges that we have to think about, in the sense that we've went the period post-financial crisis of having inflation at very low 0 to 2% levels. We're now sitting with inflation at a slightly higher level, but nowhere near the peaks that we were talking about last year. So as a group, we think we will still continue to see inflation this year. We won't transition to a period of deflation. That would just not be helpful from an economic perspective. And you look at Japan, they've been trying for 30 years to get away from that challenge. So we don't want to end there, but an inflation at a more manageable level from where we can all plan and think about the implication that has is probably the reality of where we are. And as we look to this year, we certainly see it feeding into different areas in different ways. Energy is a good example of that. The price cap here in the UK as to how that rolls its way through. So there will be base effects as those higher levels roll out, but we will still have inflation, albeit at lower levels.
Thanks, Jeff. Anybody want to add anything into that?
I think when you talk about inflation, you've always got to, when we talk about how it feels from a personal point of view, yes, prices are going up in the shops. It's then a question of, well, do the earnings of the population or do my earnings keep pace with that increased prices? So there have been times over the last year where earnings growth has actually outstripped inflation. So arguably it should feel a little bit better when those types of events come along. But then you've also got counteracting that, things like your personal tax allowance. That's kind of fixed for the next, 4-5 years. So you are losing a little bit more than what you'd hope to. So inflation does bite.
Yes.
Earnings can keep pace with it, but tax is also a drag. So
nice way to summarise.
Well, yeah. As Jeff says, when it comes down to that 2-3% level, it's manageable and it does start to feel a bit better year to year from a personal point of view. Great.
Thanks. Charlotte, is it better to invest smaller amounts monthly or larger sums sporadically?
I would say kind of invest in as much as you possibly can.
Yeah.
It's a great way to kind of meet your savings goals and things like that. But obviously you will have to take into account what you can probably afford each month.
Yes.
I think that's probably where the advice side comes into it.
Yeah. John, anything to add?
Yeah, absolutely. So Charlotte's right. Some people will have an amount of disposable income each month on a regular basis that they can put away into an investment on a regular basis, whereas other people, they might find themselves with a sudden windfall and they've got a lump sum to invest from time to time. So whether you invest monthly or one-off amounts from time to time, it depends on your personal circumstances. Which is better? It's difficult to say. If the markets have been volatile and you put a large investment into the market just before it goes up by 10%, you've obviously done quite well out of it. Yeah. But it could equally go the other way. Monthly investments have the advantage of it kind of averages all that volatility out. So if I put money into my pension each month, as I do, 1 month the markets might have taken a bit of a dip because of some volatility, but then the following month those units that I bought have grown, and then those monthly amounts just keep getting invested, and it tends to, call it pound cost averaging, it averages it out over the course of a longer period of time. Yeah. So I think Charlotte's right. It's whatever you can afford to invest. Monthly investing won't be for everyone. One-off lump sums might not be possible for everyone, but it's just when you can. Yeah, it's a good thing to consider.
Yeah, probably kind of sitting on that fact of when you can. One of the ways that you can do it is using the impulse save feature via the client side. Yeah. So say kind of come to the end of the month, you have a spare £100, you want to invest that, you can do it very, very easily via the client side. If you do want to do this more regularly, a little bit more consistently, you can also set up direct debits on there too. Very similar to the impulse save. You can amend these every single month. So say, for example, we've just had Christmas, if things like that are coming up, or birthdays and things, you can amend it ever so slightly for the next month. But it's a really, really great tool just to kind of keep clients on track, get them towards hitting their savings goals. What's really good about it as well is when clients are typing in these figures for the impulse saves, the direct debit, it's going to give them a projection on how that's going to look and how it'll affect their policy as well. So I think it's a really, really great tool to keep on track of your savings and investment goals.
Brilliant.
It's probably easier as well once you set up the direct debit. You kind of forget about it as well. So you can get the benefit of the pound cost averaging just by doing nothing, really, just making that regular contribution.
Brilliant. Another one for you, Jeff. Do you think 2024 will be less volatile in comparison to recent years?
a bit like sort of John's crystal ball. I kind of feel I need a crystal ball for that one.
Hard to
I think the asset markets will always be volatile. It's the level of volatility that we probably have witnessed with COVID, then with the inflation shock that came post-COVID, and then into the energy price shock from Ukraine. It feels as if that has brought more volatility into markets, and that probably is really visible to people in terms of what's happened in the bond market and what's happened with interest rates. And that certainly has fed into volatility within parts of a multi-asset portfolio where maybe people hadn't seen that for the past 10 to 15 years. I think the other thing about volatility is that we can have assets that react differently at different points in time. The challenge that we saw, in particular in 2022 and periods of 2023, was that the correlation of all assets was very closely correlated. So what do I mean by that? When sovereign bonds were falling in value, the yields rising, we were also seeing a similar dynamic with equities. Historically, the relationship would be uncorrelated. There would be a different correlation profile between them. So that positive correlation as opposed to a negative correlation was the thing that I think has made people sense that volatility is higher. If we look at measures of volatility in terms of the VIX that we can look at for equities, it's actually not trended that much higher. Indeed, it's lower. Right. Over time. The volatility has really been in bond markets. Mm-hmm. So can I sort of bring that together and say, well, that might have changed? I think the answer to that, well, it depends on where interest rates go. But we've taken interest rates, if we think about it, from effectively 0 to 5.25 in the case of the US, which sets the tone globally. It's probably more challenging to build a scenario. Now, you can build any scenario you want. To build a scenario that takes rates from 5 to 10 is probably more difficult. So that should mitigate some of that volatility that we've seen in bond markets, and even more so, as we've seen and discussed recently, it's much more about central banks being at the peak of their interest rate hiking cycle. Interest rates coming down should, all else being equal, be a more positive for the return element, but also help that volatility and the correlation of assets that we've seen. So volatility will always be there. Yeah. It's how we then construct and build portfolios to help clients navigate through that, and how we explain what's happening in the portfolio, either through the investment team or through the advice team. That, I think, is the crucial element to that.
Definitely. And I think we learn a lot from the Thursday webinars that you run as well, with a lot of the advisors that can then pass that information down to clients too. We get a lot from that. And I think you go into quite a lot of depth in terms of speaking about the volatility in that sense too. Is there anything anybody else wants to add into that one?
No, I think Jeff's summarised it quite well, being the expert that he is. I
think we'd like to hope that it would be less volatile.
Yeah, we would like to hope so. But like anything, we can't forecast where that will go, because if you take that step back, we know that trying to forecast what can happen in asset markets is exceptionally difficult. There are many variables that need to be brought into bearing on that. There are very few people that are very good at it. Yes. And I think if you acknowledge that and you want to invest and use diversification, the different correlation profiles of assets to work for you, you then can find a way to navigate through volatility. And just thinking about the previous question around whether it's better to put a lump sum in or to pound cost average, in a more volatile environment, pound cost averaging certainly works for you. Yes, it's great to be able to put a lump sum in, but you might get your timing wrong. Yeah. Which again is back to the point, well, actually, should you try and time markets? The answer is no. Yeah. But allowing your assets to work for you in that power of compounding of returns through time, recognizing that volatility is there. But if we've got a diversified portfolio of assets, it provides a way to navigate through that and maybe acknowledge it's just real, but it's about being invested for 5, 10, 15, 20 years.
The long term.
And it's the longer term dynamic. So again, over the long term, and if we look at asset markets on a rolling 5, 7, 10-year basis, you're compounding positive returns.
Yes.
It's not about negative, positive, negative, positive.
Yeah. Fab. On to you, John. What happens if I put more into my ISA than the annual allowance?
Yeah, so at the moment, you've got an overall ISA allowance of £20,000 that you're allowed to pay into an ISA or combination of ISAs, say cash and stocks and shares. So when it comes to ISAs, there's actually quite a lot of permutations of ways you can pay different amounts in the different places. Now, if you've got one ISA, say for example, it's my True Potential ISA, it's actually very difficult to exceed the allowance because it physically won't let you put more than £20,000 in.
Yeah.
The difficulty comes when you are paying into more than one ISA. Like I say, for example, a cash ISA and a stocks and shares ISA, someone might pay 7,000 into one, forget that they've done it, and then pay 20,000 into another, just purely by accident. Now, the way HMRC will resolve that, they'll usually get in touch after the end of the tax year and let you know that you've made that error. All ISA providers kind of report how much an individual has paid in to an ISA each tax year. Most of the time, you're just going to be asked to take the money back out so that you return to the £20,000 allowance. So if I've put 25 in by mistake, they'll say, no, that extra 5,000 isn't allowed to remain in the ISA. You're not allowed to have it in that sort of tax efficient product. So the provider will usually return it to you once you've had a conversation with HMRC. As I say, there's a lot of different variables. There's lots of different types of ISAs. So the exact way that it's resolved can differ from case to case. But generally speaking, you'll speak with HMRC if you've breached the 20,000 and they'll instruct you on what they want you to do to fix it.
Yeah, fab. So there's not necessarily any fines that are kind of incurred normally anyway?
Not necessarily. I think if someone was repeatedly dumping loads of money into ISAs with the intention of gaining an advantage, HMRC might have something to say about it, but most of the time it's a genuine mistake and it's just undoing what you've done to satisfy the tax authority.
Great. This question is kind of open to all really. Is property a good investment and how does it compare in the long run to a portfolio?
I suppose there's many ways to think about that, isn't there, in terms of is it a good investment? And we could probably debate what is even a good investment.
Exactly. What's the property market like? What's the investment market like?
And I think for the True Potential portfolio solution, if I come at it from that angle, we don't own direct property in any of the solutions, and a large part of that comes back to the liquidity profile of property and the time lag between wanting or needing to sell something or invest it and having that asset there. We do have exposure to investment trusts, real estate investment trusts that have property as part of their investment criteria, and really that's about having exposure to business parks, warehouses, things like that, where there's a rental stream associated with that. And that gives us an income level associated with those investment trusts as well. So we use those a lot more in the income portfolios that we have. They are quasi-equity. So from our perspective, from a liquidity perspective, they don't present any challenge because we can trade them there on a day, all else being equal. That's probably the key difference between maybe somebody as an individual level that he'll have an equity portfolio or a multi-asset portfolio and then may own other properties around the outside of that as well.
Yeah. I think that's it. A lot of people do come to you with the question, should I invest in property as a pension or should I invest in a pension? I guess that leads in maybe to the advice side, John. Yeah,
absolutely. So, if someone's got a pension of 100,000, 200, 300,000, whatever it is that they've got in their pension fund, with, say, a portfolio that Jeff's team would run, that diversification is one of the key benefits. You're not overexposed to any one particular region. You're kind of positioned so that if one particular asset class isn't quite doing what you want it to do, you've got others to kind of make up the slack. If you put a £200,000 pension into a single asset, one property, you are kind of beholden to the property market.
Yeah.
If the property market, if values come down, that's your pension, that's coming down in value. You don't have any other kind of assets around that to make up the shortfall or to counteract that. So
You're not spreading the risk, I guess. In that
Exactly
sense,
right.
yeah.
It's, you say putting all your eggs in one basket. It is exactly that. You've got one asset that you're, as I say, beholden to, whereas with a portfolio, you've got thousands of different types of assets in different locations and geographies. And it just helps to counteract that volatility. So it's, both have their place.
Yeah.
It just depends how you structure it from a personal point of view.
Yeah. It's a good answer. Anybody else got anything to add to it?
Me.
No? If not, I think we could finish it there, really. We've had a good question and answer special. Thank you, everyone. Thanks, John. Thanks, Charlotte. And thank you, Jeff. And we hope you join us for the next episode. Thank you very much for watching.